Welcome back to another property pilot video. Now, a question that I get asked a lot is buy to let dead. Marco, why are you borrowing money now around 7%? Interest rates are so high. Well, if you want to know how the top 1% of investors invest, watch this video. And in this video, I'll share with you not only an example of how to invest, but we're going to talk about other really key considerations towards the end of this video. So, are you content being an average investor who's probably out the market now, who thinks rates are too high? Or do you want to invest like the top 1%? If so, continue watching. By the end of this video, it's my aim that you'll know how to invest like a pro and invest with confidence. For those of you that don't know me, my name's Marco. I'm a portfolio landlord, property investor, developer, and mentor. And I'm incredibly passionate about helping people invest in property. So before we go in and jump into a real world example together, and I'll show you how the top 1% invests, I just need to understand and I need to define to you where we are in the environment at the present time. Now, you may be watching this video in a couple of years' time, but this is still applicable. There'll always be times in the economic cycle as we're experiencing in 2023. So where are we now and what are people thinking? Well, the base rate is 5.25% at the time of recording. It may have changed by the time this video is released. And a lot of people think that interest rates are high. And as I've already mentioned in a previous video, we as humans think in a relative manner. So rates have been so low for 15 years. Well, of course they seem high if we compare them to the past 15 years. But, and here's the incredible but, if you take a long 50-year average, the last 50 years in the UK, and you look at the base rate, I think you'll find, you'll be pleasantly surprised anyway, but you'll find these rates are not high. They're around average. And just to illustrate this fact, I had Andy Westerdale on the channel. Now, Andy's got more property experience than me. He started investing in the 1980s, and he doesn't think interest rates are high. So if Andy doesn't think interest rates are high, and he's got far more experience than most of us when it comes to property, then trust me, they are not. Now, at the time of recording, you can get buy-to-let limited company mortgages for around 7%. In fact, just under 7%. And if you can't make a property deal work at 7%, I'm sorry, but I don't think property is right for you. 7% isn't that much money to be borrowing in any line of business. So, a lot of businesses would bite off their hand to borrow at 7%. So I'm going to teach you here how we can borrow at 7% as we can do now. Or here's the amazing thing, in the future, we may be able to borrow for slightly less, which means our returns are far greater. Now, the second thing that I don't necessarily agree with is a lot of people that are saying buy to let is dead. It's well and truly dusted. Well, here's the thing. If you're buying at market value and you're giving that property to an agent to manage, then yes, buy to let is pretty much dead, because by the time you've paid your agent fees, there's no money left in it for you. But here is the magic. I'm going to tell you the secret formula on how to invest in property the right way, or at least in my opinion, the right way, and how you can really grow your property portfolio in a short time span. So what is the solution, I hear you're asking? So here is the solution before we go on to the real world example. It's very, very simple. Whenever you are investing in anything, there's a simple mantra to follow: buy low and sell high. Now, the incredible idea when we apply this logic to property is as follows. First of all, when we say buy low, well, that equates to buy below market value. So, you know what, if the property's worth £100,000, we're not paying £100,000 for it. What's the point? We've got no equity. We want to be buying that property, say, for £80,000. So the day we complete, we have £20,000 equity in that property. That's number one, buy below market value. Nice and easy to understand, right? But if we take the second half of this mantra, which is, sell at a high price, well, do we want to be doing this in property? You could quite easily sell at a high price and copy and paste, but that means you have to buy a property and sell it to make the money. What if you could buy at a really good price, not sell, but get most of the money that you would have got if you sold the property but don't sell it? So what I'm trying to describe to you now is how we buy a property below market value, don't sell it, but we refinance it or finance it at a later date, pull out some cash from that property, and then we've got enough cash to either go again or do whatever we want to do with that cash. So we don't actually have to sell the property to make the money, which is an absolutely incredible thing. We don't have to sell the property, and an even bigger bonus is, because we haven't sold the property, but we've refinanced, we've pulled money out, we don't pay tax on that until we sell the property. So again, that's another reason why we don't need to sell the property to profit in buy-to-let property or many other property strategies. So here's the part you've been asking for. Here's the real life world example that I can give to you right here, right now. And we're going to be ultra conservative with our figures, ultra conservative. And I just want to show you how not necessarily easy, that's not the right word, but how you can make lots of money in property when the base rate is relatively high, 5% plus, which means you're borrowing probably somewhere around the 7% mark. There's still an awful lot of money to be made in property. Now, I don't teach, complex advanced strategies. I just teach the very basic, simple strategies that have made me hundreds of thousands of pounds and are responsible for me having a multi-million-pound portfolio. This is a real example that is actually for sale as we speak. Now, by the time this video is out, I highly doubt this opportunity is still going to be for sale, but you never know. So this property is based in Sunderland. It's a 3-bed terrace property. Now, we can get this for £70,000, okay? Now, the current market value of this property is £90,000. So you're getting a £20,000 discount to what the property is worth. That's absolutely great. So as soon as we complete on this property, we don't have to do any work whatsoever, and we've got £20,000 in equity, right? That's incredible. So that's number one. But number two is there is an opportunity to add value to this property. So here's what I mean. It needs about £5,000 spending on it, a little bit of decorating, and literally that is it. And once we do that, we can increase the value to somewhere between £100,000 and £105,000. In fact, there's a property for sale on the exact same street at £105,000. What a great comparable, right? So we're buying below market value, we're adding value only by a small refurb. And lastly, number three, the absolutely amazing part of this is the yield. So this property is vacant at the moment, but let's assume we put £5,000 into it and it looks, as good as new. We're doing a bit of painting, maybe a few carpets, and that's literally it. So it looks nice and fresh and ready to move in. Well, we can rent this property for about £700 per month. Now, I know people that are renting 3 beds in this area at £750. Again, I'm being conservative to make a point here to show that it is possible. Not only is it possible, it's highly profitable. So we're renting this property for £700 per month. That's £8,400 over the year. You can work out the yield. It's above 11%. It's an absolutely incredible yield. So let's go over the figures in detail. If we were to buy this property with a mortgage and pay the going rate now, which is just under 7%, there are plenty of lenders out there, limited company, buy-to-let lenders, that will give your company money for just shy of 7%. And let's see how much money we can make of this deal. So follow through with me. I'm getting my calculator out now so we can go through the figures in real time. So we're buying this property for £70,000, right? And we need to put in a 25% deposit to make this purchase happen. So what is 25% of 70,000? The deposit is £17,500. That's what we need for the deposit, okay? We also need stamp duty. Stamp duty is 3%. And 3% of £70,000 is £2,100. We then got our legal and mortgage broker fee. Let's just combine that together and say £2,000. We also have the refurb, which is £5,000. So let's add all of this together and see how much cash we've got invested in the deal. This figure comes to £26,600. So the cash that we need to make this property happen is £26,600. Okay, let's remember that figure. So let's come on to how much money this property is going to make us every single month. Now, we know the rent is £700 per month, and that's a conservative rent. Well, what's the mortgage cost? Well, we're borrowing 75% of the purchase price, which is £70,000, which is £52,500. Now, if we're borrowing this at 7% on an interest-only mortgage, and yes, you can get mortgages just shy of 7%, so again, let's overestimate, our monthly repayment is going to be £306 per month. Now, I'm going to reduce this to £300 per month just to make the math easy and so I can do it all off the top of my head. Now, what else do we need to deduct? Well, for those of you that watch the channel know that I allocate 10% of my rents to things such as voids, maintenance, insurance, everything that it costs to run that property. So 10% of 700 is 70. So every single month I'll put £70 aside, and I'll know by the end of the year I've pretty much would have spent near enough all of that contingency. And just a side note, across my whole portfolio, every single year I actually understand how much money it costs me to run properties. And what I found is kind of bog standard freehold property, it costs me 9% of the rent to run that property. But I find 10% is a nice easy number to attribute, and again you've got a small contingency in there too. So we've got our rent, £700 per month. We've got the mortgage, £300 per month. We've got our maintenance and all other things, £70 per month. So once we've taken away £370 from our rent, we're left with a monthly rental rental profit of £330 per month. That's absolutely incredible. I thought buy-to-let was dead, was it not? If you're getting a buy-to-let property and you're making over £300 per month on something that you're just putting in 26 grand for, I think that's an incredible investment. And we haven't even touched upon the equity that we've got in the property, nor the capital growth yet. Before we even do this, let's work out our return on capital employed. So as I mentioned before, we've got £26,600 of our own cash invested in this property. But if we look at how much this property is making us on an annual basis, so we take that monthly profit and times by 12, it gives us with £960 per annum, which is a very healthy profit, more or less £4,000 profit per annum. Absolutely incredible. So let's work out the return on capital employed. And this formula measures our annual return over the cash we've got invested in this deal. So we put our annual profits, which is more or less £4,000, over the cash we've got invested in the property, which is £26,600. It gives us a return on capital employed of just below 15%. If you want to get technical, it's 14.88%, an absolutely incredible return. But buy-to-let's dead, isn't it? I don't think it is. So now that you're making a 15% return, which is absolutely phenomenal and an incredible return just on the rents alone, let's come on to the equity we've got in the property and let's come into the capital growth, because we haven't even really touched upon this yet. Now, let's say we're buying this property in 2023 and let's be ultra conservative. So we already know the market value, once we've done the work, is somewhere between £100,000 and £105,000. Let's just call it 100. Let's be on the safe side. And let's just say, you know what, in the next, I don't know, 5 years, maybe the property is going to increase in value 20%, which again is a very conservative outlook. So we're going to end up with a property that's worth £120,000 within 5 years of purchase. We purchased the property for £70,000 and 5 years later it's going to be worth £120,000. So what's the difference? Well, you've got £50,000 equity in that property, £50,000 that you have made over those 5 years. That's £10,000 per year just on the equity and the increase in value of that property, which is absolutely incredible. And really, once you include this in your figures, your return on investment jumps significantly. Now, it won't take you long at all for this particular property to have earned you more money than the cash you've invested in the deal. So we know we've already put in £26,600. We get £4,000 more or less per year with the rent. Absolutely great. And we've got £20,000 equity from purchase and £5,000, at least £5,000 equity when we finish the refurb. So we've got 25 and 4. 20,000 below market value, 5,000 post works, and 4,000 per year on the rents. Well, you add that all together, that's £29,000. So if you actually hold and own this property for 1 year only, you've got your money back. What an incredible return on investment. So that's how I'm borrowing at 7% and buy-to-let still works for me. Don't get me wrong, this relies on coming across very good deals. But if you put in the hard work, the time, the effort and energy to generate these deals, there's no reason why you can't come across those deals too. If you do want to come across these deals, sign up to our weekly property newsletter. Every single week we've got a property opportunity to purchase and all these properties are below market value. We will not post anything in the email that is market value. So if you want to join the weekly email list, first of all, it's absolutely free and everyone gets first access to the deals. There is a link in the description on the YouTube video, or go to the website, which is ms7.uk/email. So I want to give you two key considerations that makes these figures look far better than what we've already referenced so far. Really important lessons to think about when analysing a deal. Number one, there is such a thing as rental inflation, where your rents will increase or hopefully increase every single year in line with inflation. So let's take the example we just spoke about where we allocated £700 per month to the rent of this property. Now, I've already suggested that this is a conservative figure and in fact we could get more than this. But as the years progress, as we own this property over the 5-year ownership, we are going to be passing small but regular rent increases. Maybe we're only passing on a £25 rent increase every single year and that's absolutely it. But this alone, again, significantly boosts our return on investment. That's another way to make buy-to-let work for you. Don't just think about the rent this property can achieve now. What can the property achieve in rent in year 2, 3, 4, and 5? The second icing on the cake and the second consideration I want you to think about, I can't guarantee this, but it may happen, is a lot of people are thinking that rates are going to fall in the 5 years to come. So let's take this example. Let's say you fixed for 5 years. You fixed a mortgage for 5 years and we know we're paying roughly £300 per month for this particular property. Well, when that 5 years comes to an end, what's the interest rate going to be? Well, we don't know, but a lot of people think it's going to be less than what it is today. So when you're coming to refinance this property, and if you want to keep it, that is, all of a sudden you could find that your mortgage payment drops. Maybe it drops from 300 to 250, or maybe even 200. I've still got some mortgages where I'm only paying around £100 per month for a property. They're stuck on very, very low rates. Don't get me wrong, they're coming up for expiry soon, but rates could fall. Now, if rates fall, what happens? Your profitability increases. So if we combine these two considerations together, let's say that our rents increase over time due to rental inflation, but also our mortgage costs maybe falls after 5 years. All of a sudden, we could be in the scenario where, in the previous example, we're making £330 per month. We could be making £450 per month on a single buy-to-let property. So buy-to-let is not dead, and think about the future. If you can get a really good deal agreed now, it's going to look far, far better in the future when rents increase, when values increase, when hopefully, fingers crossed, I can't guarantee it, lending costs fall slightly. So there we have it. You know exactly how the top 1% invests. You know how the pros do it. It's simple. Buy low, buy below market value. Now, if what I've said has resonated with you and you're looking to grow your property portfolio and potentially take on a mentor, someone who's been there, done that, and got the t-shirt, well, book a call with me. I'd absolutely love to help. How to do this? Go to my website, www.ms7.uk, click on the coaching and mentoring, scroll to the bottom and book a call with me. I've also got a link in the description on this video. Thank you very much for watching the video. I really do hope you learned something new. If you've got something to say or would like to comment, you know where to comment below. And if you take anything away from this video, it's two things. 7% is fine. You can still make money by borrowing at 7%. And the second thing is just buy below market value. Please buy below market value. All the very best with your property investing day. Goodbye.